Welcome to ForexTV.com's PM Exchange. It's Tuesday, December 18th. I'm Remy Hokie. Today I'm joined by Joe Francomano, Vice President and Manager of FX at Erste Bank. Good afternoon, Joseph.
Hi, Remy. How are you today?
Good, thanks. Thanks for coming on the show.
Thanks for having me.
Well, as we enter the final trading week of '07, we're still seeing volatility in the financial markets. But ending '07, we've seen a shift in the central bank outlook. And I would like to start out by talking about this morning's ECB news. They injected a record $500 billion for the next 16 days. And we saw rates for Euribor decline on this news. But if you could tell us how this affects the FX market.
As far as what it did, it was very calming, actually. The fact that the ECB injected over $500 billion to, I think it was about 390 institutions, showed that they were there to provide liquidity. Meaning, and more importantly, from an FX standpoint, I think they were there to show that they can be a very calming influence. And today's foreign exchange trading day mirrored that. I mean, basically, it was extremely calm. You had some traders bottom picking in the euro dollar, a little bit in the dollar yen, and so on. But for the most part, the event of the day was, of course, the ECB injecting liquidity, and again, what it had what its effect was to again calm the market. We saw 1 week vols come off sharply as market participants now expect. I'd like to say a quiet, remainder of the week in foreign exchange, although given illiquidity in FX, that can never be certain. But again, barring any extraneous events, it did seem to be that the actions of the ECB today, the Fed, and the central bank's announcement last week has had a calming effect on the market, and in a sense, it seems to be a little tranquil.
Okay, well, Joseph, as you mentioned, as we get closer to the end of the year, we'll start to see holiday thin trading. And if you could tell us whether or not you expect to see consolidation in the major pairs.
Absolutely. We have broken down recently, technically, in the euro dollar. We're poised to break down technically in the sterling. But given the backdrop that, for instance, about a month or so ago, the Canadian dollar, which had been the strongest currency in the world, rebounded from 90 cents to back above parity. So that's a 12% correction. We saw dollar yen rebound from 107 up to 113. That's about a 6% or a 5% correction. We've seen sterling pull down from 211 to 201, again about a 6%. The euro dollar is only consolidated from its all-time high of 149.70 down to this 143, 144 of only about 4% or so. So in context, compared to the Aussie and the Canadian and the sterling, you would think that perhaps that there remains some risk to the downside of the euro going forward over the next couple weeks. Do I feel like the market can consolidate? Yes, I do. I think that is, that would be, how do I say, probably the path of most likely outcome. However, it is December and it is illiquid, and it doesn't take that large of a flow to move this market right now. And if you do get a large flow, i.e. a central bank or some sovereign interest that comes in one way or the other, you could see the market move 2 or 3 big figures now over a 24, 40-hour period. Now, going back to what I said initially, technically the euro dollar does seem to be breaking down from a summer low of around 133.5. We are technically in my charts we're looking for perhaps 141 or so, maybe even as low as 140. But again, I don't think the market wants to go that way, but given the illiquid conditions, I would not be surprised if that's where we ended up.
Okay, Joe, well, taking a closer look at data that has come out today, sterling saw weakness against both the dollar and the euro, and we had CPI data come out this morning. But looking ahead to tomorrow's session, we have the BOE minutes coming out, and the BOE minutes, this will be about the latest rate cut.
Right.
So if we keep our eyes on that, and also if you could give us your expectations going into '08 for the BOE.
Well, the Bank of England kind of wanted it both ways at their last meeting when they cut rates. They cut rates, but their statement seem to indicate that not that they regretted to do so, but that this might have been a one-off occurrence. It was interesting. The Fed did the same thing back in October. They said they were cutting rates, but don't expect us to cut any more. And November showed what the market thought of that policy. So I do believe that the minutes will show a reluctant Bank of England, and that perhaps may give sterling a bit of a bounce. It may help the sterling. We saw sterling closing around 201.5 or so today. You could see sterling, catch a little bit of a bid if the minutes show some hawkish testimony. However, with the backdrop of what the Fed did and then what the market did to the Fed subsequently after the October FOMC meeting, I wouldn't not be surprised to see sterling trading on its back foot. And as I alluded to earlier, the technical support, a major technical support in sterling is around 201, big figure right now. And if the market doesn't buy what the Bank of England's selling, you could see sterling definitely falter going into the end of this year. You could see sterling fall. Obviously the psychological level at 2 will be obviously some support, but I don't put much grain into it. And obviously the euro sterling rate is around 71.5. You could see that climb back above 72. You could see sterling easily fall below 2. This in the next 2 weeks or so. But again, this would be. I don't think that the market wants necessarily to do this, but if flows start pushing it, in this illiquid market right now, these minor flows could have a larger momentum.
Okay, and while we're on the topic of central banks and inflation, recently we got a surprise rate cut from the Bank of Canada, and we also got inflation data out from Canada today for CPI. But given the volatility in dollar CAD, do you think recent dollar strength against the CAD is overextended?
Yes, I want to think that the Canadian dollar as a commodity currency is mirroring the price of oil. And with oil generally hovering around $90 after failing at $100, you can make the direct correlation that that dollar Canada, once it broke parity and ran, it was moving very well bid and firmly with oil running up towards $100 and Canada running towards 90. You've obviously seen oil backtrack. There are some forecasts. I'm not an oil market analyst, but what I've read is that there's a chance that price of oil could fall back towards $80 or so in the first quarter if the world economy is going to slow like many experts expect. Now, given that context, with a weakening oil market, with a Fed that has already cut rates, and a Bank of Canada which is reluctant to cut rates but may be forced to, then perhaps you could see the Canadian dollar weaken further. I think technically right now, we've seen it above 102, but it's back down to trading between par and 102. But if you do see the Canada start to weaken, you could see it move towards 105, and then once it gets around 105, then it starts getting a little bit dicey. And again, I'll discount what's going to happen in the next 2 weeks because I don't think there's enough evidence really on the table, and there's not enough market participants. But come January, if the price of oil starts to falter, if the global economy starts showing signs of creaking a little bit, if the Bank of Canada deems that weakness in the United States is going to lead to further growth cuts here by the Fed, which would then lead to further cuts by the Bank of Canada, you could see that buying dollar Canada at or just around parity as being a good buy going forward. Okay, and Joe, one last currency I want to touch on is the Japanese yen. The dollar against the yen has been fairly range-bound, trading between 112.75 and 113.50 in today's session. But also equities have been seeing a seesaw of a trading day, and they have rebounding, ending higher. But going forward, what do you see for dollar yen as well as the yen crosses? Well, what I think we have seen in the last week or 2 weeks or so is a decoupling. Yen was always, weakening yen meant stronger stocks, and then obviously November's extreme volatility led to obviously risk aversion, which led to buying back of the yen against everything. Now, over the last week or so, you've seen dollar yen, particularly dollar yen, stay firm. And on the flip side, you've seen the equity markets gyrating plus or minus 1% every single day. So I don't believe that the going forward for the next 2 weeks, that the equity correlation between yen and equities is so strong. What I do believe is I will go back to a forecast that I read back in the beginning of summer that end-of-year dollar yen would, by the BOJ, forecasted around a 114.5. Do I think that 114, that dollar yen should remain firm? That the dollar, that we'd return back to 117, 118? No, not at all. I think that the first quarter of 2008, you're going to see the markets remain rather tight, and I think that dollar yen on approaches with 113 or 114 may be good levels to start selling dollars, buying the yen, and that I do believe that a return back towards below 110 will be seen in the beginning of 2008. I also, in that same vein, I think euro yen is struggling with a 160 handle right now. We're around 163, 164. If what I'm expecting holds true, I think euro yen is also going to struggle. I think euro yen back below 160 is in the cards as well.
Okay, Joe, as always, thank you very much for your insight and analysis.
Thanks for having me, Remy.
This has been your Forex News with Joseph Francomano, Vice President and Manager of FX at Erste Bank. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks ended another volatile trading session in positive territory. In a seesaw of a day, the major indexes traded down in the morning and then climbed higher in the afternoon. Today, the ECB injected cash into the market, pushing down European money market rates. Meanwhile, a profit report from Goldman Sachs surpassed forecasts. And in today's U.S. data, housing starts fell 3.7% in November to a 1.187 million annual rate. Starts for October were upwardly revised to 4.2%. And building permits fell 1.5% for the month to a 1.152 million unit rate. At the closing bell, the Dow Jones Industrial Average advanced 65.27, closing at 13,232.47. The tech-heavy Nasdaq gained 21.5 to close at 2,596.03. And the S&P 500 added 9 to end the session at 1,454.98. And in the fixed income market, U.S. Treasury prices rose after a liquidity injection by the ECB. At the end of today's session, the 10-year benchmark Treasury note rose with its yield at 4.12%, down from 4.15% late Monday. The 30-year bond gained with a yield of 4.54%, down from 4.58% yesterday. And the 2-year note rose with its yield ending at 3.17%. In energy, crude oil futures fell for a fourth straight session after erasing gains from earlier in the session. Today, there was news that Turkish troops started to withdraw from northern Iraq. This had led to reduced fears that crude oil supplies will be threatened in the Middle East region. Crude for January delivery ended the session down by 14 cents at $90.49 a barrel. Meanwhile, January crude oil expired at the end of today's session, and February crude, which will become the front month contract tomorrow, fell 97 cents, ending at $90.08 a barrel. Elsewhere on the NYMEX, January RBOB gas fell 3.11 cents, closing at $2.30.43 a gallon. January heating oil lost 4.25 cents, closing at $2.55.54 a gallon. Meanwhile, January nat gas futures added 10.1 cents, closing at $7.136 per million BTU. Over in the metals complex, gold futures climbed above $800 an ounce on the day. February gold ended up by $8.10 at $807.40 an ounce. In other metals, January platinum soared to a new record high of $1,526.40 in electronic trading. The contract ended the session with a gain of $11.70 at $1,515.30 an ounce. Meanwhile, March silver rallied 18.5 cents, ending the session at $14.165 an ounce. December copper ended little change at $2.87 a pound. This afternoon, we're joined by Derek Fry from O&F Futures and Options. He'll give us his outlook for energy and metals futures.
Okay, recapping the action we saw in the energy and metal sectors. I'll start with the metals today. I saw a rally in pretty much both gold and silver today. Not a major rally, but definitely, yeah, you can't look at a daily chart and not notice the kind of very large-scale coil formation that's forming up right now on that daily chart. That's usually a continuation pattern, which points the way, in this particular case, to higher prices. So we've been shorting above 810 for the last few weeks, 810 and 815, and covering on these dips below 800. And at this point, we're pretty much ceasing that, and we're really looking now to accumulate some longer-term long positions below that 800 level, preferably. So we're definitely kind of rolling over and looking more towards the bull side than the bear side in the near term. Kind of the same thing in silver. We're accumulating some longer-term long positions on dips below $14. Like I said, we're really looking to kind of hold on to these things into January, and probably through January for that matter, and into February. Over to energy, we saw a really wild mixed day today in energy. Saw the market trade, in both positive and negative territory. We were light buyers on the dip, the intraday dip below $90 on the January contracts, but really not any major addition to our overall core position, which we had put on back below 88 on the prior dip. We continue to see another push back up to and more than likely through 95, coming probably by Christmas, certainly by the New Year at the latest. Frankly, beyond that, we could see a run to that $100 level still. So we continue to be bullish and accumulate longs below 90.
That was Derek Fry, head trader at ONF Futures and Options, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.